Hello everyone and a very warm welcome to today's stock markets update for Monday, March the 10th, 2025. This is a special emergency update where we are going to address the anatomy of a impulse. It's blood red on the street. The bleeding is not stopping. The patient keeps losing blood. This is of course in reference to the previous two updates we did. So we have to go over the facts. Objective facts. It is bad news everywhere. Even the New York Times shows us an hourly chart of the S&P 500. Market Watch, of course, is completely bearish. And so is a quick internet search. Just type in stock market and this is all the negative news that we are seeing. It is negative everywhere. So how bad can it get, right? Well, let's assess some of the charts using objective analysis, using known patterns and not emotions. We are preferring the Elliott wave to assess where is the market. Now we believe the market is either in now a larger fourth wave or in a smaller fourth wave, okay? And we are basing that on the anatomy of a impulse. Normally, the third of a third wave reaches the 100 to 123.6% extension of the first wave measured from the low of the second wave. So this is your first wave, second wave. And then the 100% to 123.6 is here. The fourth wave of the third wave reaches then the 76.4 to 61.8. And the fifth of the third wave reaches 138 to 161.8. As everybody knows, third waves tend to target 161.8. Sometimes they get longer, sometimes a little bit shorter. As long as the third wave in the entire impulse is not the shortest wave, we're good to go. This is the basis and the premise of the advance within the stock market. And this we already discussed in Friday's webcast. I just wanted to reiterate it and go into even deeper detail so you fully understand on why are we thinking the market will go much higher. We will also show work of many other people that we highly regard and to show you that they are also thinking we are still only in a fourth wave. Okay? All of us are thinking and seeing we're still in a fourth wave because since the March 2020 low, you cannot count 5 waves up and the stock market is bullish in the long term. We must see 5 waves up, not 3 to the extent that we've seen so far would be never seen before. And that is of course quite unusual. So once again, this is the Fibonacci based extensions and we're not sucking this out of our thumb and we're not just pulling this out of thin air. This is based on Elliott Wave's work, okay? Mr. Elliott work. This is also on public websites. This is common knowledge. Now, we must say this is a standard Fibonacci-based impulse pattern, and the market doesn't have to follow standard Fibonacci-based impulse pattern. We go over that in a moment. As long as the third wave is not the shortest wave, it can kind of do whatever it wants to do. So this is what we have to keep in mind. So let's then assess the stock market, in this case the S&P 500, since the March 2020 or the COVID low. We can clearly count 1, 2, and so far only 3 waves up. There is no other way to count this than only 3 waves up. We cannot have this as a 1 and this a 2 and this a 3 and this a 4 and this a 5. That would be so disproportionate to have if we say, well, this is 1 and this is 2 and this is 3 and this is 4 and then this is 5. We have a year-long wave 4 and this is then a week-long wave 2. That is, of course, entirely disproportionate. So we're not going to do that. That is, of course, preposterous. It's possible, but preposterous. So what do we see instead? We see 1 waves up. This is the weekly chart, by the way. Okay. This is the weekly chart. So these are weeks, and I can account pretty much for every single week. Down weeks are second or fourth waves. And of course, in a bear market, up weeks are, of course, B waves. Now you can see the Alt 1, Alt 2 here. It's fine. The the gist here is, where did we top, right? Where did we top? That line went a little bit wrong there. Where did we top for the S&P 500? Well, it's quite easy. We topped there, okay? Right at the 100% extension. Now my marker doesn't want to work for whatever reason. There, the 100% extension. What did we just learn? Third waves tend to reach the 100 to 123.6% extension. That's what we just learned. So the wave 3 of 3 reaches the 100 to 123.6. And so far we topped right here at the 100% extension. 61.13. I think we got to 61.47. A slight breach. Now this is one way to count it. So since the August 2020, we have here this ending diagonal wave 5, which are very tricky. And I'll also show you it has potentially not followed an ideal Fibonacci-based standard pattern for a ending diagonal, but that's okay. They're less reliable. We can count simply 5 waves up into the late 2024 low. And now we are doing what looks like a irregular expanded flat wave 4. What did we also learn from this standard Fibonacci-based pattern? So the wave 3 right here at the 100%, that the wave 4 can now go as low as 61.8. 61.8 is at 51.12. This is as low as we can go. Not a problem. If we go below 4,800, all bets are off. If we go, of course, below 3,500, we're definitely in a bear market. If you look here at the weekly chart, we're still well in a long-term uptrend line. Okay. Yes, we've gone below the 10-week, the 20-week, and now potentially below the 50-week. That's not the end of the world. We're still above the Ichimoku cloud, and the long-term 200-week is still rising. And as you can see, oftentimes the market finds support all the way there, right? As you can see there. It might breach below it, but this is a very critical long-term trend line. And we're well above it, so the long-term trend is still bullish. On long-term, the stock market trends higher. If we've topped for the top of all tops, then what's the point of having any money, because our society is done and you can pack your bags and be done and over with and kiss your grandchildren goodbye. And clearly, based on the facts of what we just shared, we're not there yet. So why so serious? Is it bad? Yes, of course it's bad. Have we had a big drop? Yes, we had 10-15%. It's happened many times before. So let's not get too excited here and just apply the facts. So this blue target is a 38.2 to 23.6% retrace of either, depends on how you exactly count the 1, 2, okay? If it's alt 1, alt 2, it's fine, 3, 4. But technically 100%, we can go all the way down to 5,100. I know that's another 500 points, this is another 10%. And then we'd be looking at a 20% correction. 20% within the stock market. They tend to happen about once a year, something like that. Or once every other year, something like that. This was a very steep correction. This was a very steep correction. And we'll get another one. But based on the fact of what a standard Fibonacci-based impulse pattern does, the third of a third wave has stopped. The fourth of a third wave is underway. And maybe really we need this sour sentiment that's currently out there to get the next potentially 2,000 point rally in the S&P 500. From current levels, there is 1,500 points upside reward, potential upside reward, and about 400 points downside risk. So you already have 1, 2, 3. Okay. I'm not saying you should be buying here. We have zero confirmation that the low is in place. As I even pointed out on Friday, we can still go lower, and that's indeed correct. It can continue to subdivide lower. Okay, and I'll go over that in a minute. So I really don't want to focus too much on the hourly scribbles because this has been quite a tough subdividing C wave lower. Potentially an A wave. So this would be an irregular flat wave 4. I'm fine with it. And then we had here a double zigzag wave 2. All good. After 4 comes 5. And that's still pointing much, much higher, potentially to as high as 7,700. If it so desires. It depends all where we are going to bottom for this wave 4. Okay. Why? Because of course wave 3 can never be the shortest wave. So on the daily chart, you can see that we have pretty much ditched all the wave labels since this decline started. We've breached below all the warning levels for the bulls, where we thought, well, we could still try for another wave 5 to that 64, 6500 level. Forget about it, not going to happen. Now in this wave count, this is akin, of course, to the weekly chart. We have the A, the B, and now a C wave lower on the way, which can subdivide further, okay, into 13. It can even subdivide into, of course, 14, 15, 16, 17, 18, 19, 20, 21. That we don't know. There is zero signs of a bottom in place. We've had double positive divergence, but as you can see here, the market has now completely ignored it. That's why we say divergence is only divergence till it's not. It's a condition, it's not a trade trigger. We've broken below the 200-day moving average. It held all week last week. All right, on Tuesday, on Wednesday, on Thursday, and on Friday. And as I said, actually the whole week wasn't that bad. If you compare to where we closed on Monday at about 58.50 and where we closed on Friday at about 57.75, you only got about 75 points down for the whole rest of the week. Today is bearish. We've broken below the 200-day moving average. So we're so far in the 9th wave. Up days are counted as 2nd, 4th, 6th, 8th, and of course down days as 1, 3, 5. Impulses move in 5. If it subdivides 9, subdivides further 17 or 13, even further 71, 21, etc. So far we've now done the bare minimum of 9 waves lower. It could have done enough already here at 5 waves lower, okay? It could have even done enough here at 3 waves lower. This was close to the 58.10. It keeps subdividing higher. We need to see, as I said on Friday, a higher high and a higher low. And if we don't see a higher high and higher low, then a lower high and lower low it is. And that's what we get. Okay, we're extremely oversold. That's all nice and dandy. Those are conditions, not trade triggers. We now need to get at least above 57.08. And then we need to break at least, I would say, above 58, like Friday's high, somewhere at 5,800, but ideally above 58.55, because then we have erased this down, up sequence. That's what we need to see, and we're not seeing it. So this can still subdivide lower. And then we have a rather, I must say, ugly ending diagonal 5th wave. So this was 1, this was 2, this was 3, 4, and 5. That's what matches with the weekly chart. Sorry for that. Sometimes the marker doesn't want to do what it wants to do. So the 3rd wave tends to top here. The 4th wave tends to bottom here. The 5th wave tends to top here. So this ending diagonal, potential ending diagonal, has missed the mark, but that's okay. It just shows you we don't necessarily have to follow the ideal Fibonacci-based pattern, especially not for an ending diagonal. There are technically enough waves in place, and then this is A, this is B, and this is C. Now, why do we have it? Because this B wave did tag the 138.2 much better, okay? And oftentimes when the 3rd wave fails to do what it has to do, then the B wave does the trick. But I have zero signs of a low in place, so please be aware of that. Now, this is the alternative wave count of a larger ending diagonal, which actually neither matches with a Fibonacci-based impulse pattern. And I shared that with you before with work from our friends at ElliottWaveTrader.net, where in an ending diagonal, the 3rd wave tends to go to 123.6, the 4th wave down to 61.8, and then the 5th wave to 161.8. But as we just saw, if this wave count is correct, it doesn't have to do that, okay? It can fall a little bit short. So we don't have to, and in this case we have a 3 equals 1. That means that wave 5 can never be longer than wave 3. Okay, this is the max length of wave 5. Now then we should be in an A wave, a B wave, and a C wave down to the 161.8, which one, and once again is 51.12. Okay, we can go as low as 51.12. That's the same as we're seeing here for this 4th wave as well, 51.12. It's very possible we go that low. I know it's scary, but we have to adapt and we have to use objective analysis. So then we have accounted for 1, 2, 1, 2, 1, 2, 3, 4, 3, 4, 3, 4, 5, with some shallow fourth waves. I don't really like the wave counter too much, where there's wave 1 is quite long compared to the other ones. It matches. Again, it's not normal for a third wave to reach the 100% extension. It's not. But it's not that it must go to 123.6. Okay, we can have a 1 equals 3 equals 5 Fibonacci-based impulse pattern. Okay, and then as high as 77.34-ish is the maximum. So somewhere around 77,700 is then the maximum. And then we get simply a 1, a 2, a 3, a 4, and a 5. Okay, and this can go all the way, as you can see, if we follow this trend line, right, all the way. If we bottom here later this year, this can then go all the way there, right, all the way there, which gets us really into late 2026, 27. So please be aware of it. We have all these negative divergences first and foremost to deal with. And it wouldn't surprise me if this is the case. I shared this slide with you before. I just want to show it. I'm not pointing out that Avi's work is bad or anything, just showing that one of the best Elliott waivers out there, probably with one of his largest subscriber base, also shows that 1.236 is typical target for a third wave in the diagonal. Okay, so far we haven't even reached it, right? Which is at 67.32. Also here, it's at 67.32. We've completely missed the mark. But it's typical. It doesn't have to be. Nowhere does it say it's set in stone. We must reach it. And then the fourth wave goes to the 0.618 extension. Also typical. And then the fifth wave goes to 161.8, 176.4. Also typical. But we don't have to have necessarily a typical ending diagonal. If this is the case, it shows you it's a bit atypical. The fourth wave was completely pathetic compared to the second wave, but it matches. Okay, it does work this way. So that's the alternative. If we really drop it below 54.85, we're going to look to 5100. And again, it doesn't mean at all that the bear market has ended. We have to drop, I would say, below the 50% extension at 4800 to really suggest that it's the case. And of course, ideally 3490, but if we go that low, that's not good, because then we start to really miss the Fibonacci retracements for fourth waves. So let's then look at the NASDAQ 100. It has extended further. Also here you can see the March low of 2020, and also here you can still see only 3 waves up. All right, this is wave 1, wave 2, wave 3, and now a wave 4, and then a wave 5. Okay, and here you can actually see that the third wave almost reached 123.6, which is at about 22,760. I think we got to 22,222, if I'm not mistaken. You can also see that here we have a potential ending diagonal fifth wave in green. We reached the ideal target zones pretty much for the third and the fifth wave. So yes, this looks complete. And yes, we can go all the way down to 18,000, potentially even 16,500. Okay, so this still looks like a normal impulse pattern of the March 2020. It is impossible to count 5 waves up. If you have a 1 year long wave 2 decline, you need to see something more than just 2 weeks of a wave 4. Okay, this would then be A, B, C, and then wave 5. And again, wave 4 can go here between 18,000 and 16,500. Yes, that low. So we then expect a bounce and then a C wave. But as we just saw from our friend Avi Gilbert, we can reach the 176.4. So if we get a 5 is 1, we can go even to almost 30,000. Okay, we don't have to go to 161.8. We can also stall at the 138.2. To be determined, I cannot predict the future. What I'm showing is so far with the data at hand, we do not have 5 waves up of the March 2020 low, and since we've been making all-time highs, this cannot be some sort of massive irregular B wave. So applying this wave count to the daily chart, we then get this. Then we are now in wave A. We're going to get a bounce for wave B, probably to about 20,500, maybe 21,000 to be determined, and then the wave 4. Okay, so here also we have completed our 5 waves up. Fine with me in diagonal fashion. Sorry for that. Sometimes the market gets stuck. Okay, also here, the positive divergence on the RSI5 been negated. We've broken below the uptrend line that has held price in check. And we've, of course, broken below this critical wave 1 high already before. It's still okay, of course, in a ending diagonal, but this has gone too far. Too far, my friends, means we have to adjust. So we have 1, we have 2, we have 3, we have 4, 5. Now you can see here the wave 3 reasonably close to the ideal target. Wave 4 right in the ideal target. Wave 5 missed it by a little bit. Okay, that's still concerning, but it missed it by a little bit. So far, also, the current decline is 1, 2, 3, 4, 5, 6, 7, 8, 9, but we can easily get 10, 11, 12, 13. Okay, to be determined. Also here, we need to see at least 2 up days in a row. So far, we've only had 1 up day. If we get 2 up days in a row, it really starts to suggest the trend has changed. So this advance since the August low has reasonably matched that of a ending diagonal. So we can be fine with that. The alternative is that we got the wave 3 already, as I showed you for the S&P 500 in 2024, and this is the C wave of the wave 4. Why? Because C waves are impulses, so they move in 5, 9, 13, 17 waves. Okay, so it could be the C wave underway. And then the C wave can target again 18,000 to 16,500. It's still the same. We're still there. We're just going to go there quicker, much quicker. Okay, we're on our way and we're probably going to wrap it up real soon. This is the weekly chart, and look how oversold we are getting on the weekly chart. And look what that used to bring us. Okay, at the minimum, very decent bounces. But the weekly is getting very oversold. It's a condition, it's not a trigger. We're breaking below key moving averages. We have negative divergence to content ourselves with. And also here, you can see if I count it slightly different, we can still match this of a ending diagonal wave 5, this red wave 5. The wave 3 topped where it had to, the wave 4 bottomed where it had to, and then the wave 5 almost topped where it had to. It fell short a little bit. We topped at, I believe, 22,000. We should have done 22,373. Well, then the B wave tends to do the trick. Remember, that's just what I said for the S&P 500 as well. I think the B wave got to 22,222, and we should have gone to 22,370-ish, something like that. So we got awfully close, and now we're in a C wave, okay? And this is the C wave. Once again, the C wave can easily subdivide. I have zero indication we have a bottom in place. And then we can still subdivide. And that's what I showed you as well in Friday's hourly chart for the S&P 500. We can continue to subdivide. That's why we need to break above previous highs, right? So if you have, of course, 5 waves lower, 1, 2, 3, 4, 5, then you think, oh, it's done. Well, no. So this is then 1, this is 2, this is 3, this is 4, this is 5. No, this could be 1 of 5, okay? And then this is 1, 2, 3, 4, etc. So it can continue to subdivide until you break above one of those previous highs. Now, I do want to point out once again here that we've not really done, in this case, an ideal Fibonacci-based impulse pattern. Again, the wave 3 should have targeted 123.6, fell a little bit short. Wave 4 tagged it really nice. Wave 5 tagged it pretty good as well. Again, 22,004 through 700 should have been better. Fell a little bit short, and as you can see, the B wave then almost did the trick. A, B, C. Very good. I cannot distinguish the B wave, technically, from a 5 waves in the ending diagonal because it's all ABCs. Ending diagonals are ABCs and B waves are ABCs. So that's the 2 paths we're looking at. But you can see here, even in this wave count, we're looking at the same downside target. The other one is looking for a bounce pretty soon. So this is then A of 4. We get the bounce for B and then C and then blast off. Okay? To be determined which one the market prefers. Overall, we're still missing a massive final 5th wave at a minimum from the March 2020. I cannot hammer it home enough. Okay? I cannot hammer it home enough. So this means then this wave 4 is still underway. It can subdivide. Most likely it will. We will revisit those target zones, 18,000 to 16,500. Okay? 18,000 We're getting close already. If we get there instantly, that means that we are going to subdivide in 10, 11, 12, 13. So we'll just let the downside play out, okay? Do not catch the falling knife. We have zero indication that a low is in place. This is the Dow Jones. And first thing I want to point out is that C waves can be quite extended. The March 2020 low was 2 times the length of A, actually a little bit more. So this is then wave A, this is wave B, and then we had 5 waves lower for wave C. Normally, C waves are equal to A or 1.618, and here we even went a little bit beyond the 2 times of A. So we don't necessarily have to have a C-A relationship. I do want to point out once again that the recent all-time high has been confirmed by the MACD, and it would be very odd to have a top in place with positive confirmation. We want to see negative divergence, okay? We don't have that yet on the Dow Jones. And the Dow Jones is the mother of all indexes, by the way, so it's very prudent to keep a good eye on her. Most likely we are in this red wave 4, which can target about 40,000, okay? Potentially even 38,000. It's fine. This is wave 4, then a wave 5. Again, also here, we've not even reached the 100% extension of this wave 1. Also here, I can account for every down month, this is the monthly chart, as a impulse for the top in 2021. Every down month is a second or a fourth wave, okay? 1, 2, 1, 2, 3, 4, 3, 4, 5. Then we get wave 2. This was a irregular running flat wave 2, and I have 1, 2, 3, 4, 3, 4. This is the preferred wave count because the top here fell very short of what normally is a third wave high. Normally, even a third wave high goes to 161.8. So this is then wave 4, and then we still get a wave 5 to either the 100% or the 123.6, potentially even the 138.2. So that's why we have this huge target zone there. I cannot predict the future. We have to wait and see. Again, I cannot count 5 waves up since the 2020 low. Anybody can, fantastic, but then it's really disproportionate. So also this index decided to continue to subdivide lower. It had done technically enough waves lower since stop here in January, but it looks like it wants to subdivide higher, lower, not higher, lower. Also here, positive divergence is cracking. It's a condition. It's not a trade trigger. Zero confirmation. At a minimum, we need to get back above Friday's high. At a minimum, because then we start to make a higher high. I want to see a higher low and another higher high. So this looks like it's subdividing. And again, this would then target somewhere in the high 40,000s. Okay, somewhere around there. Maybe 41,000 plus or minus 500. Very possible. How does that match with the Fibonacci? Reasonably well. 40,274. 40,274 targets it right there. Okay, let's see here if I can get it. There. Yeah, that seems quite reasonable. Okay, so I don't think the downside is done yet. And then we have the A, the B, and the C with a subdividing wave 5 of 5 underway. Again, subdivisions can always happen. I cannot foresee them. When we have completed, once again, the 5 waves lower, this can be 1 of 5, 2, 3, 4, 5, okay? We need to get above the previous 4th wave to suggest or tell us that the 5th wave is not going to subdivide. So moving on to the alternative, and that is that we are in a large ending diagonal wave 5, okay? This would then be wave 5 right there. It's very possible. And also here, we'll then be looking for the 38,000 to 40,000 level. Nothing out of the ordinary. We're still in a long-term uptrend, and this would then be a massive ending diagonal. All right. By the way, if you want to point out that megaphones are bearish, no, they're really not. Yes, within the megaphone it's bearish, but they always resolve bullish because they tend to be 4th waves. They were primary 4s in the 60s and 70s. They were a cycle 4 in the early 2000s. They were a primary 4 in the late 2010s. And once again, we are in a potential megaphone pattern. Okay, meaning the current decline since, I would say, late last year. Also here, it's the same chart, monthly chart. We can easily target 40,000 to 38,000. And then at the minimum, we can still target 47 to 52,000. Okay, this would be a less than ideal Fibonacci-based ending diagonal pattern. 1, 2, 3, 4, 5. But why is this? Because in this case, wave 3 is of course shorter than wave 1, which means wave 5 has to be even shorter than wave 3. So if we target here the 50% extension, then wave 5 cannot go higher than the 150% extension, which is at about 54,000. Okay, so that's why this target zone is a little bit lower. All right. So we've reviewed every single chart based on the known, which is the standard Fibonacci-based impulse pattern for a standard impulse, as well as that for an ending diagonal, showing that the ending diagonal can be a little bit more variable and that we have to, of course, adjust accordingly, and that we're now in a C wave or in an A wave of wave 4, one of those two. So now let's have a look at what other people are seeing. First, we mentioned Avi's work. Also here, he's looking for lower prices for a larger fourth wave. Can easily target 5,500. That's what we're looking for as well. Okay, so far, nothing out of the ordinary. And then a wave 5. His most bearish alternative is this large wave 5 or 505, etc. has already topped. But as I showed you, it doesn't match with his own work. This is from our website, elliottwavetheory.net, the basic of Fibonacci pinball, to show you that what I had on the slide is exactly the same. This is what they're seeing as well. And we so far just reached this wave 3, okay, the 100% extension. So we do want to apply the right wave labeling based on those Fibonacci's, and that would be quite odd to already have the larger wave 5, this wave 5 top already here. Not saying he's wrong, not saying he's bad, just want to point out that what we're applying is nothing out of the ordinary, exotic, or anything. This is standard Elliott wave work, standard Fibonacci-based impulse patterns. So let's apply that to the market, which is just what we did. Also here, looking here for a low in about, I would say, low 5,600s to low 5,500s. This is a video posted on X by Xenia Taubina. I hope I pronounced her name correctly. She is now looking for a larger fourth wave between 5,100 and 5,400. Matches very well what we just shared with you. And then a massive large fifth wave, as you can see, all the way here to the 7,000s. Okay, so matches really well with what we're seeing. 4, 5, right? See the 5? 4. Again, if we start going below 5,100 and especially the 4,800 somewhere level, that would be very concerning. For now, that is a little too far away from our bed. We're sticking with what we're seeing. Didn't put in any granularity on this wave 4, but I just did that. We should see something like that. All right, but also here, she's looking for a larger fifth wave. By the way, I didn't point it out. Avi Gilbert is also looking for a larger fifth wave to at least 6,500. Note he's placed his Alt 3 label here, okay? Lock that one in, meaning this could be 3, and then we have 4, see that? 4, and still 5. So please be aware that, yes, this label here can be moved there, and then can be moved there once again, okay? So please be aware of that. And this Alt 3, of course, matches with our Alt 3. Okay, if we go real quickly back to the S&P 500, right? Let's go back there. This is the S&P 500, 67.32. And what do we get here? 65.45. That's within 200 points, getting pretty close for that wave 3. Then a large wave 4 would not surprise me at all. That's our preferred path. And Xenia is seeing that as well. She's looking for 7,000, okay? But anywhere probably between 6,700 and 7,000 for this larger wave 5. So Avi is looking higher once this correction is done. Xenia is looking higher once this correction is done. We're looking higher once this correction is done. This is from pure Elliott Wave. Slightly different wave count, but should have outlined and aligned with what we're seeing as well. Also here, ultimate target range is 8,000 to 8,600. That's for 5 for 5 for 5. Would match with a 200% extension. It's fine with us. What matters, target at around 67.50, and that we're currently in a wave 4, an A, a B, and a C. Again, matches really well with what we're seeing, okay? Nothing out of the ordinary, A, a B, and a C. This is for the Dow Jones, and of course the same here is for A, B, C there, potentially A, B, C, all right? nothing out of the ordinary. And again, this wave 5, I don't even have it on the map yet, would target about, is from 34 to 6,000. That is 1,500. Yes, it gets very close to 8,000. So pure Elliott wave is seeing the same as we're seeing, is the same as Xenia and Ivy Gilbert's, that we're still needing a massive 5th wave to complete a larger 3rd wave. All right, see that? 3, then 4, and then 5. So eye on the price, high 6,000s once this completes. She's looking here, or pure Elliott wave, not Xenia, sorry. Pure Elliott wave is looking for a low in the 56, 5,500. I'm fine with it if we assume this is an A, a B, and a C. Again, could be an A as well. So we have then we're going to get a zigzag lower. So this could be A, this could be B, and then C. Or again, A, B, C. All right? Those are the 2 alternatives. And this is work from Avery at ATM Snipes on X. He was looking, this is in November, also for the completion of a larger 3rd wave. And due to the fact that this turned into a ending diagonal, we missed the upside target. For SPY, he was looking for about 60.40. Well, of course, I don't think that was reached. We got about 16.15, but that's because of the fact that we were dealing with a ending diagonal wave 5, then a larger 4th wave down to, I believe, ideally 5,400, potentially as low as 500 under SPY, and that we are currently, of course, then in this A wave, right there. Same deal. Most importantly, after 4 comes 5, targeting as high as low to high 700s for the SPY, of course. This is not the SPX, this is SPY. Also here, the rally since the 2020 low has not completed, and he also shows that the 2021 high was 1, the 2022 low was wave 2, and we're now in 3. We're going to be in a 4, which might complete, and then a wave 5, okay? That's what we're looking. Still a large 5th wave is missing. And with that, I want to conclude with liquidity drives markets. And this is a recent tweet by Colin Crypto, where he's looking at the global M2 money supply and has found a very nice relationship that has worked over the last 15 months since the beginning of 2024. It's a correlation and they can always fall apart, but it worked really well with Bitcoin and also for the S&P 500 because liquidity drives markets. This is the global money supply in yellow. Again, I'm not sharing anything proprietary. This has been posted on X, and you can see money supply is quite anemic for February, March. All right. However, late March, this is going to implode, and then look in May. This is going to implode, explode like crazy. And liquidity drives markets. Of course, fear and greed are important as well. I've already seen people saying that fear and fear greed index don't work anymore. Don't. Well, if that's the case, the stock market doesn't work anymore. Fear and greed still work. Liquidity still works. And we're kind of like in a dry spell. Now, liquidity is often pre-planned already. This is forecasting and looking forward and suggesting that we should bottom out pretty soon. Now, I cannot, of course, make a wave count of this, but it tells us that we might see at the minimum, of course, a bounce, maybe a decline, etc. There's more to the market than just liquidity. There's many variables. However, this is very important, and it shows you that so far it's following the stock market and crypto quite well. Actually, crypto and the stock market are following it quite well. And in this case, the money supply has been offset by 76 days, pushed forward. It seems that the supply needs a longer time to make its way into assets. Money supply is everybody's money. It's your checking, it's your savings, it's cash, it's your CDs, it's your investments. And as you can see here, if we plot that forward, it means eventually it will find its way into the stock market. So I think we've done a very rigorous, long assessment of where do we think we are. We've looked at other people's work that really produce high quality Elliott Wave. All of them align, okay? Xenia's work, Avi's work, Avery's work, and pure Elliott Wave, they all align with ours, okay? We've adjusted our wave count accordingly, and we believe either the market is wrapping up a final impulse lower, or it is wrapping up the initial A wave. We get a bounce and then a B wave. And somewhere between 5,400 and 5,100 is an easy target for this fourth wave. And from there, we should see well into the 7,000s. That's what we're seeing. That's what other people are seeing, as we still cannot count 5 larger waves completed off the 2020 low. That's really the bottom line. And most likely we need this sour of a sentiment to kick in the next 2,500 point rally on the S&P 500. And with care, trade safe and have a great rest of your day.